The Seven Price Doji is a concept in financial charts that suggests an extreme rarity where, theoretically, a security or trading instrument has the same opening, high, low, and closing prices for 7 consecutive trading sessions. While this is theoretically possible, the occurrence of such a pattern is exceedingly rare due to the dynamic nature of markets. Price movements are influenced by a multitude of factors including economic data, investor sentiment, and global events, making the likelihood of such precise repetition minuscule. In the section titled Conclusion, Beyond the Myth, it is discussed that while intriguing, the Seven Price Doji is more of a theoretical construct rather than a practical tool for traders. The market's complexity and constant fluctuation mean that relying on such an exceedingly rare pattern for trading decisions is not advisable. Instead, traders and analysts are encouraged to focus on more established patterns and analytical tools that consider a broader range of market factors. This approach is grounded in practicality and recognizes the importance of adaptability and comprehensive analysis in navigating the financial markets. In exploring the intricate world of advanced market patterns, it is essential to navigate with precision and attentiveness. Advanced market patterns are like a labyrinth with intricate paths that can lead to profound insights or complex challenges. These patterns delve deeper than the basic trends and indicators, offering a closer look at the movements within financial markets that can signal potential opportunities or risks. Understanding these patterns requires a combination of historical market data analysis and the application of statistical tools to recognize recurring themes or anomalies. By studying advanced market patterns, one learns to identify the subtle nuances that drive market movements. This involves recognizing the significance of specific formations, such as head and shoulders, double tops and bottoms, and more complex configurations like Elliott wave patterns or Fibonacci retracements. Each of these formations offers clues about potential market reversals or continuations, acting as a guide for making informed investment decisions. Effective navigation through these patterns demands a thorough understanding of market psychology and the external factors influencing market dynamics. This includes economic indicators, geopolitical events, and even investor sentiment, which together contribute to the overall market environment. In conclusion, mastering advanced market patterns is akin to solving a complex puzzle. It calls for meticulous analysis, a keen eye for detail, and the patience to observe and learn from the market's signals. With dedication and practice, one can enhance their ability to forecast market trends, thereby making more strategic investment choices. When discussing identifying the maze, characteristics of complex patterns, it is important to approach the topic with clarity and attention to detail. Complex patterns exhibit several key characteristics that make them stand out. Firstly, these patterns often show a high degree of variability, with many elements changing in unpredictable ways. This unpredictability is a hallmark of complexity and can make understanding the overall pattern a challenge. Secondly, complex patterns frequently exhibit interconnectivity or interdependence among their parts. This means that a change in one area can have cascading effects throughout the pattern, making the system sensitive to initial conditions. Such sensitivity is why small changes can lead to vastly different outcomes, a concept often referred to as the butterfly effect in chaos theory. Additionally, complex patterns tend to self-organize. This self-organization is the process by which pattern and structure spontaneously arise in the system without a central command. The emergence of such order from seemingly random interactions is fascinating and counterintuitive, indicating an underlying set of rules or dynamics driving the pattern's evolution. Lastly, complex patterns can evolve over time. They are not static and can adapt in response to changes in their environment. This adaptability allows the system to survive in fluctuating conditions and further contributes to the complexity of understanding and predicting its behavior. In summarizing these characteristics, it becomes clear that complex patterns present a significant challenge in analysis and comprehension. Their unpredictability, interconnectedness, ability to self-organize, and evolve over time make them intricate puzzles. However, recognizing these attributes is the first step in navigating the maze they present, allowing for a deeper exploration and eventual understanding of their dynamics. Deciphering sentiment from complex patterns requires understanding both the subtleties of the market movements and the emotional underpinnings that drive investor behavior. In the context of financial markets, additional complex patterns refer to intricate combinations of price movements, trading volumes, and time frames that can signal deeper market sentiments. These patterns may emerge from the collective mood of the market participants, reflecting optimism, pessimism, or uncertainty. Patterns like head and shoulders, cup and handle, or flag formations do more than just signify potential price movements. They whisper insights about the market's emotional state. For instance, a head and shoulders pattern might indicate that after a period of optimism, the left shoulder, followed by a peak of euphoria, the sentiment turns negative as investors fail to push the price to new highs, leading to a downturn, the right shoulder. Deciphering these signals involves looking beyond the simple geometry of the patterns. It entails an analysis of volume to confirm the strength of the sentiment and other indicators that might suggest a convergence or divergence from what the pattern suggests. For example, a surge in trading volume on the breakout points of a pattern may confirm a strong market conviction behind the sentiment suggested by the pattern. Thus, understanding these complex patterns is not merely about identifying shapes on a chart. It involves piecing together a narrative about market sentiment, looking at how patterns emerge from the interplay of price action and volume, and interpreting what this means for future price movements. This method requires both analytical skill and a measure of intuition developed from experience in observing the markets. In the section titled "The Fork in the Road," continuation or reversal, we delve into the complex realm of identifying whether a financial market trend will carry on in its current direction or take a pivotal turn. This point of decision is likened to standing at a fork in the road, where each path represents a possible future course for market movements. When faced with such a juncture, it's critical to examine certain patterns and indicators that can help determine the market's next move. To do this, investors and analysts use a combination of chart patterns, volume analysis, and momentum indicators, among other tools. Chart patterns, such as head and shoulders or triangles, can signal that a trend is about to reverse, while consistent volume growth in the direction of the trend can indicate its potential to continue. Momentum indicators, like the Relative Strength Index, RSI, or Moving Average Convergence Divergence, MACD, provide quantitative means to assess the strength and sustainability of a trend. A high RSI might suggest that an asset is overbought and could be on the verge of reversing, whereas a bullish crossover in the MACD can signify that the current trend has enough momentum to continue. Understanding these signals is crucial for making informed decisions at this proverbial fork in the road. However, it's equally important to remember that no single indicator can provide absolute certainty. Thus, investors often combine several analytical methods to increase their chances of accurately predicting the market's next direction. In summary, the fork in the road, continuation or reversal, discusses the critical point at which investors must decide whether a market trend will persist or change course. By carefully analyzing patterns, volume, and momentum, one can better navigate this decision point, though it requires a nuanced approach that considers multiple factors to increase predictive accuracy. When exploring additional complex patterns and focusing specifically on confirming the path, several key factors come into play. Identifying and understanding these factors is crucial for ensuring precision and accuracy in the process. Firstly, historical data plays a significant role. It provides a foundation by offering insights into how similar patterns have unfolded in the past, giving clues about potential future behavior. Secondly, current market conditions cannot be overlooked. Being aware of the prevailing economic environment, including any geopolitical events or policy changes, is essential. These factors can significantly influence market reactions and the way patterns develop. Thirdly, volume analysis offers another layer of confirmation. It involves examining trading volumes alongside price movements to gauge the strength of a trend. High volume during a particular movement suggests strong market consensus, adding credibility to the pattern identified. Lastly, sentiment analysis, which assesses the mood or attitude of market participants, can provide valuable context. Understanding whether the market sentiment is bearish or bullish helps in predicting how a pattern might progress. In summary, by carefully considering historical data, current market conditions, volume, and sentiment analysis, one can more confidently confirm the path a complex pattern might take. This comprehensive approach aids in making informed decisions, enhancing the strategy's effectiveness. Evaluating the reliability of maps in terms of their historical accuracy is a multifaceted task. It requires understanding what the map depicts and how well it represents the geographical knowledge and cultural perspectives at the time of its creation. Historical maps were not just tools for navigation. They often reflected the scientific, political, and artistic trends of their eras. For instance, early maps might have inaccurately sized continents due to limited exploration, but can still offer insights into the explorer's perceptions and the technical limitations of that period. Moreover, the purposes behind creating these maps ranged from asserting territorial claims to facilitating trade. Such intentions could influence how territories were represented, making some maps more subjective than others. The technological tools and methods used to create maps have evolved dramatically, impacting their accuracy. Today, satellite imagery and geolocation technologies have transformed mapping, offering precision that was unimaginable in the past. Hence, when considering a map's historical accuracy, it is vital to contextualize it within the technology, purposes, and knowledge of its time. This process allows us to appreciate maps not only as geographical tools, but also as historical documents that offer a window into the world, views of past cultures and societies. When exploring additional complex patterns and the section on integrating analysis tools, it becomes clear that the journey of understanding financial markets involves companions, namely, various analytical tools that enhance decision-making. These tools range from fundamental analysis, which assesses the intrinsic value of securities, to technical analysis, which focuses on chart patterns and price movements. One of the critical aspects of integrating these tools is recognizing their complementary nature. For instance, while fundamental analysis provides a broad view of a company's potential for growth based on financial statements and market position, technical analysis offers insight into the market's sentiment and potential price movements by scrutinizing past trends and patterns. Embedding these tools into one's investment strategy facilitates a more holistic approach. It allows an investor to not only understand the financial health and potential of a company, but also to gauge market trends and investor sentiment effectively. This integration can lead to more informed decisions, potentially increasing the chances of achieving favorable investment outcomes. By making intricate patterns in market behavior and investment potentials more discernible, these tools collectively serve as reliable companions on the journey toward financial market proficiency. Their combined application fosters a comprehensive perspective, critical for navigating the complexities of investing with greater confidence and insight. When discussing additional complex patterns and exploring the section titled Navigating Pitfalls, Common Misinterpretations, it is essential to approach the subject with clarity and depth while ensuring the explanation remains accessible. Complex patterns in any field, whether they are found in data analysis, behavioral science, or financial markets, often come with layers of nuance and subtlety. The intricacies of these patterns can lead to misunderstandings if not evaluated carefully. Misinterpretations commonly arise from a lack of context or from making assumptions without considering all available information. For instance, in technical analysis of the financial markets, a pattern that seems to indicate a trend reversal might be misread if the analyst does not account for volume of trades or market sentiment. Similarly, in data analysis, a pattern might suggest a particular correlation, but without considering external variables or the quality of the data, conclusions drawn might be flawed. To navigate these pitfalls effectively, it is vital to 1. Verify the context in which the pattern appears. Understanding the broader situation can provide critical insights into what the pattern truly signifies. 2. Examine the underlying data or factors thoroughly. Rather than taking the pattern at face value, look into the components that contribute to its formation. 3. Consult multiple sources or viewpoints. Sometimes bringing in an alternative perspective can highlight aspects not previously considered, helping to avoid misinterpretation. In sum, while additional complex patterns hold the potential to unlock deep insights, they also carry the risk of leading to incorrect conclusions if not approached with a comprehensive understanding and awareness of common pitfalls. In our discussion on additional complex patterns in the financial markets, it is essential to understand that these patterns extend beyond the basic formations often first learned by traders. These patterns, which may include formations like head and shoulders, cup and handle, or complex Fibonacci retracements, provide deeper insights into market sentiment and potential price movements. They require a more nuanced interpretation and often signal significant shifts in market trends. Turning to the section on charting the course. Entry and exit strategies, we delve into the critical aspect of knowing precisely when to enter and when to exit the market. The emphasis is on the importance of timing in achieving successful trading outcomes. Entry strategies might be based on specific patterns completing their formation or on indicators reaching particular levels that signal a trade. Exit strategies, on the other hand, focus on preserving gains or limiting losses, often through the use of stop-loss orders or by setting specific price targets at which to close a position. For effective application of these strategies, traders use a combination of technical analysis tools, including but not limited to price charts, volume, moving averages, and momentum indicators. These tools help in identifying the right patterns and signals that dictate optimal entry and exit points. It is not just about recognizing the right patterns, but also about understanding the market context in which these patterns form. The goal is to make informed decisions that align with overall market trends and individual risk tolerance. In summary, mastering additional complex patterns and devising strategic entry and exit points are pivotal to navigating the financial markets. By combining technical analysis with a keen sense of market timing, traders can enhance their ability to execute successful trades. Exploring the section titled The Uncharted Territories. Variations and similar patterns involves diving into the complex world of patterns that may not be immediately obvious or widely recognized. This area focuses on the nuance found in patterns that deviate from the standard or are characterized by subtle distinctions that demand a keen eye to discern. In this realm, understanding variations entails recognizing how seemingly minor adjustments in a pattern can lead to dramatically different outcomes or interpretations. It is akin to navigating a maze where each turn represents a variant of a pattern, and the choice of path can lead to new discoveries or insights about the underlying structure. The study of similar patterns, on the other hand, involves identifying the shared characteristics among disparate patterns. This requires a deep understanding of the core elements that define a pattern, allowing for the connection of dots across different contexts or disciplines. It is like viewing a tapestry from a distance and noticing the consistent themes or motifs that emerge, regardless of the individual thread's color or texture. Venturing into these uncharted territories requires a curious mind and a willingness to question assumptions. It demands an appreciation for the complexity of patterns and an acknowledgement that what may seem random or disconnected on the surface could reveal profound interconnectedness upon closer examination. This exploration is not just an academic exercise, but a practical tool for innovation. By identifying and understanding these variations and similar patterns, one can forecast trends, solve complex problems, and create novel solutions that bridge seemingly unrelated domains. It is a journey into the heart of complexity, offering rich insights and unexpected roads to discovery.